Do you know why many long-term investors stay uneasy even after years in the market, despite steady growth and positive news? The problem is rarely effort or intelligence. It is starting without understanding the basics first. Long-term investing rewards patience, but it punishes confusion. Many investors jump in with good intentions, but no clear foundation. That leads to stress, emotional decisions, and plans that fall apart. In this video, we shall share 8 important things you need to understand before investing for the long term. These ideas come from real investor behavior, real market history, and lessons shared by professionals and regulators. They are not shortcuts or tricks. They are the fundamentals that quietly protect wealth over time. Understanding them early helps you stay calm, consistent, and confident for decades. Let's begin. 1. You need a personal financial roadmap before you invest. Long-term investing does not start with picking assets. It starts with clarity. A financial roadmap is a clear picture where you are, where you want to go, and how much risk you can handle along the way. Many investors skip this step because it feels slow. They want action. But without direction, action becomes random. Your roadmap includes goals, retirement, education, financial independence. It also includes timelines. 5 years feels very different from 30 years. Risk tolerance changes with time. Money needed soon should not face the same ups and downs as money meant for decades later. This roadmap also looks at income, expenses, debt, and savings together. Investing is not isolated from the rest of your financial life. If your monthly cash flow is tight or debt is heavy, aggressive investing can create stress. Stress leads to bad decisions. A roadmap gives structure. It helps you choose investments that match your life instead of copying someone else's strategy. Long-term investors who build plans first are less likely to panic, chase trends, or abandon investing during hard periods. Clarity reduces emotional mistakes before they happen. 2. You must understand your comfort with risk, not just your desire for returns. Every investment carries risk. That truth never changes. What changes is how people react to it. Many new investors overestimate their risk tolerance. They feel confident when markets rise. They feel fear when markets fall. That gap causes problems. Risk tolerance is not about what you hope for. It is about what you can live with emotionally and financially. If a market drop makes you lose sleep, your strategy may be too aggressive. If your portfolio never grows enough to meet long-term goals, it may be too conservative. Long-term investors balance risk and time. Assets with more ups and downs often reward patience over decades. Safer assets protect short-term needs, but may lose purchasing power to inflation over time. Understanding this balance matters. When investors ignore their true comfort zone, they react instead of planning. They sell low. They stop investing. They change strategies repeatedly. Understanding risk ahead of time allows you to stay invested when it matters most. Comfort with risk is not weakness. It is self-awareness. 3. You need the right mix of investments, not one perfect choice. Many beginners search for the best investment, the best stock, the best fund, the best asset. That mindset creates concentration. Concentration increases risk. Markets move in cycles. Different assets perform well at different times. Stocks, bonds, and cash do not move together. When one struggles, another may stabilize or grow. Mixing assets smooths the journey. Diversification is not about avoiding loss completely. It is about reducing the damage from any single mistake. No one predicts which company, sector, or country will dominate every decade. Spreading exposure protects against being wrong. Asset allocation matters more than picking winners. Too little risk may slow progress. Too much risk may break discipline. The right mix supports long-term goals. Some investors prefer simple solutions that adjust risk over time automatically. Others prefer building their own mix. Both approaches can work. The key is balance. Long-term success rarely comes from betting everything on one idea. 4. Heavy concentration in one stock or employer stock increases hidden risk. Investing heavily in a single company feels familiar, especially if that company employs you. Familiarity feels safe, but it increases risk. If your income and investments depend on the same company, one problem can affect both. Job loss and investment loss at the same time is devastating. Many people learn this too late. Diversification protects against company-specific risks. Even strong businesses can struggle. Leadership changes. Industries shift. Regulations evolve. No company is immune. Long-term investors limit exposure to any single stock. They respect the possibility of failure without assuming it will happen. This approach reduces volatility and emotional attachment. Wealth grows best when risk is spread across many sources. Familiarity should never replace balance. 5. An emergency fund is part of investing, not separate from it. Long-term investing works best when you are not forced to sell. Emergencies force selling at the worst times. That is why cash reserves matter. An emergency fund covers unexpected expenses, job loss, medical costs, repairs. Without it, investors may sell long-term assets during market downturns. That locks in losses. Having several months of expenses in safe savings creates flexibility. It protects investments from short-term needs. It reduces stress. It improves discipline. This fund is not about returns. It is about stability. Stability supports long-term growth. Investors who ignore this step often blame markets for losses caused by poor preparation. Those who build safety first give their investments time to recover and compound. 6. High-interest debt works against long-term investing. Many people invest while carrying expensive debt, credit card balances, high-interest loans. This creates a hidden drag on wealth. Paying off high-interest debt offers a guaranteed return equal to the interest rate. Few investments provide that certainty. Ignoring this is costly. Long-term investors understand order. They reduce expensive debt before chasing returns. This lowers risk and improves cash flow. Debt adds pressure. Pressure leads to impatience. Investing works best when money can stay invested through ups and downs. Clearing high-interest debt simplifies finances. It strengthens a foundation. It makes investing easier to maintain over decades. 7. Consistent investing beats perfect timing. Consistent investing beats perfect timing because it keeps you active when uncertainty tries to stop you. Many beginners believe success depends on finding the exact right moment. When prices rise, investing feels risky. When prices fall, fear grows even stronger. So they wait for a signal that feels safe. That signal rarely comes. While waiting, time keeps moving forward. Compounding does not pause. Missing even a small number of strong market days can lower long-term results far more than most people expect. The cost of waiting is often invisible, but it is real. Consistent investing solves this problem. By investing regularly, you spread your money across many conditions. Some investments happen at highs, others happen at lows. Over time, this balance reduces the impact of bad timing and removes the need to predict the future. This habit also builds discipline. Regular contributions turn investing into a routine instead of a stressful decision. Long-term investors focus on behavior, not forecasts. They accept uncertainty and move forward anyway. Consistency creates progress even when the path feels unclear. 8. Long-term investing requires maintenance, not constant action. Long-term investing requires maintenance, not constant action. Many people confuse activity with progress. They believe frequent changes mean better control. In reality, too much action often increases errors and stress. Over time, different assets grow at different speeds. Some positions become larger than planned. Others shrink. This slowly changes your risk without you noticing. Periodic review helps you catch that drift. Rebalancing brings your portfolio back to its original structure. It means trimming assets that grew too much and adding to areas that fell behind. This process feels uncomfortable because it goes against emotion. Selling winners feels wrong. Buying underperformers feels risky. Yet this discipline protects long-term balance and keeps risk aligned with your goals. Maintenance can follow simple rules. Review once or twice a year, or rebalance when allocations move beyond set limits. The exact method matters less than consistency. Constant tinkering creates noise, not improvement. Long-term investors also stay cautious about fraud. Scams thrive on urgency and excitement. Slowing down, verifying details, and asking questions protect capital over decades. Now, let us connect these 8 ideas. Long-term investing succeeds when preparation comes before action. A roadmap gives direction. Risk awareness supports discipline. Diversification spreads uncertainty. Safety buffers protect timing. Debt control strengthens foundations. Consistency builds momentum. Maintenance keeps balance. None of these ideas are exciting. That is why they are ignored. But they work. Understanding comes before confidence. Confidence comes before consistency. Consistency allows compounding to do its job. If this video helped you understand long-term investing more clearly, like it so others can find it, share it with someone starting their investing journey. Subscribe to the channel for more simple, practical guides on building wealth the smart way. Thanks for watching.